Nothing says masterclass like a shirtless dude. So today we're going to talk about rolling options, and I'm going to walk you through a quick overview of what it is. You probably already know. I want to get into some of the mechanics that people mess up quite literally all the time. And then at the end of the video, I want to walk you through a bunch of best practices and kind of some commonly asked questions to make sure that we're fully thinking through this process, because I can tell you from my own experience and what I regularly see in places like Reddit and on my YouTube comments are when people talk about rolling options, it is very clear that we don't fully understand them. The first time we see them, we have an immediate perception that this is the greatest thing ever. It's going to fix all of our problems. We can just roll things and everything's great. And that's not so much the case. So I want to walk you through exactly that. And we're going to talk about things like, when's the best time to roll? Should you roll out or up or in or down? All of those things are on the docket. So what's up, everybody? Welcome back to The Outliers, and a shout out to the Patreon family. The people in the Patreon actually get free access to the shop, weekly workshops. So if what I do helps you out, consider signing up. Link in the notes below. Let's get right to it. So here is the beginning. What is rolling? Really simple. It's closing a trade, entering a new one. What differentiates rolling from closing a trade and opening a new one? Simple. We tie the accounting together. So what does that look like in practice? Well, we have the first trade where we enter, then we exit, and then we enter again. So where's the roll in this instance? Right there. So as we enter this first trade, it's working. Then we choose to exit it and then enter a new one and tie the accounting between this position and this new opened position together. So what does this look like in terms of money? Well, in this first trade, if we sell to open a put, I just picked a random one, for $1, then we close it for $2. What happened here? Pretty simple. We realized a $100 loss. We collected $1. We closed the trade for $2. That means we give up the dollar that we collected up front, and then we give up another dollar on top of that. That is $100, because obviously you multiply this out by 100 for options. This is where the trade lands. So where's the roll? It's right here. If we buy to close at $2 and then we sell to open at whatever price, you've now completed a roll. Common misconception is that rolls are only conducted on losing positions. You can roll a winning trade. It's just in generality and parlance, when we talk about it, it's normally referred to in the context of a losing trade, which is actually quite telling when it comes to the mindset of when we roll. And this is something I do want to speak about for just a second, because it's a common problem people have, is that if this was a winning trade that you closed and then opened, you probably wouldn't consider it a roll. Why is that? Well, it's because you're happy with your win. That's off the books. Now we're entering a new trade. You don't want to tie the accounting to it because you have a win. But when we're rolling, very frequently it's fueled by hope. We hope this next trade overwhelms the loss of the previous trade. So that's why we choose to account it together. But again, admin note, you can roll winning trades as well. It's just not commonly done, or at least commonly referred to. So let's say trade 3 continues to chug along, it goes well, and we close that for 50 cents. What's happened here? Do you know what our realized P&L is at this point? In this case, we take in 150 bucks. We sold this option for $2, 200 bucks. We buy to close it for 50 cents, 50 bucks. That gives us positive $150. So on this rolled position, you will have realized a profit of $50. One of the dangers of rolling is that if you don't close this for the correct price, then all of a sudden you can be compounding your loss. So for example, if you have this $100 realized loss, we sell to open this new option for $2, then we buy to close it for $3. What happened in that scenario? We realized another $100 loss. So your net P&L at that point is negative $200. So if you keep going down that path and you don't ever get a price accommodation, you have problems, because you're going to continue compounding that losing position, which is really, really dangerous. So let's talk about some best practices. The first thing I want to walk us through is analyzing surrogate options. This is a little bit esoteric, so follow along and you can come back to this part if you need to fully understand what we're talking about. But this is something I do all the time. It's really useful. Let's come over here to XLF, and I'm just picking a random stock. And let's say you have a position on. Let's say you have this 33 DTE, and let's say when you originally sold your puts, or let's say you short calls so that we're getting ran over. Let's say you originally sold these 38 short calls and they were out of the money. Whenever you chose to sell them, it doesn't matter. But now they're in the money. So we want to do a few things. The first thing is we want to see if we're at risk of early assignment. That's a little bit of a different scenario. We need to see if there's a dividend. We need to see how much extrinsic value is left in the options. Kind of a different video concept, but that's an overview of that at least. Then we want to figure out how much is intrinsic and extrinsic value. And if you remember your options 101, you figure out your intrinsic value by how far in the money we are. Take that out of your premium, and then whatever's left is your extrinsic value. You can also look at the corresponding out of the money option for a approximation. It's not perfect, but it's pretty close. So in this case, if I'm looking at these 38 short calls and I'm trying to figure out what's the extrinsic value, we can look right over here. It's about 30 cents, something like that. Okay, good. So now we're faced with deciding different things. Like, what does this look like if time passes? What will the value of my option be? How much extrinsic value will be left? Well, you can either do the math. You can run it through your Black-Scholes model. That's no problem. You can run it through a risk profile tool if your platform has it, or you could do the easy option, at least as far as I can tell. And again, it's not perfect, but it's pretty close. So let's say that we want to pretend that nothing has happened other than time has passed. And we can look at this 12 DTE. So even though our option is this 38 call, 33 DTE, we can look at that same option that's just 12 DTE, and we can see what it looks like compared to where it is now. So in this case, it's trading for kind of a really wide market here. Let's just call it like 150, something like that. And then if you look in here, it's like 110. So over the course of this time frame, you can see how much your option would change if nothing else changed. And again, markets move. So then you can also say, well, what happens if it actually falls further in the money? What would that look like? So let's say XLF goes another $1 up. So instead of being at 39, now it's at 40. Well, what you can do is you can look at the 37s, because your option would behave close to those 37s. So all I'm doing is by the amount that I'm mentally moving XLF, I'm mentally adjusting my strike the same amount to see what the option would look like if that move happened. It's a really useful tool. Again, that might sound a little complex. Feel free to listen through this a time or two if you need, but that's what I do to analyze a lot of potential options adjustments without doing the math for every single one of them. So one of the best practices here is rolling spreads. Is it something you can do? It is something you can do. Is it something that's reasonable to rely on? No, it's not. And it's because when we're rolling options, a lot of the time, you'll find things sometimes are really deep in the money or deep out of the money. This is a great example that we were looking at with this 33 DTE. And we were looking at something that was slightly deeper and deeper in the money. Notice how if you go to this 36 call, notice how wide that market is. That's just for a single option. So if you have a vertical, you have to find the midpoint between this, which there's a lot of slop on something priced like this. And then you have to find the midpoint on whatever other option you have tied to your vertical or iron condor. The generality here is the more legs you have, the harder this is. And you're also probably going to have to move them piece by piece, which opens you up to gap risk while you're in the process of adjusting your strikes. Rolling spreads is doable. Very difficult. It's not something that I think is worthwhile in most cases. Does rolling avoid losses? The cool part about this one is you actually already know the answer to it because we just looked at this. In this example that we looked at over here, when you rolled this option, meaning you closed this one and you open this new one, did you avoid a loss? No, you realized a loss. That means this is on your books. This means you have a brand new open position that has the potential to cover the cost of this loss, but it's not guaranteed. you could also have an even bigger loss as a result of opening this new position. So no, rolling does not avoid losses. Now, on that same topic, if you rolled this option, do you know how to calculate what your break-even price is on this option? If not, it's pretty simple. So if we closed this trade, $2, $100 realized loss, you sell to open this new option at $2. How much money do you need to make in order to get back to zero on this realized loss? $100. So that means on this option, you would need this trading at $1 or less to be in profit. As soon as this hits $1, not including fees, you would be at break even. So you can easily do that math to calculate what you need this new option to be trading at to hit break even, and then also to then start seeing a profit, which is the whole point of doing this. A common error traders make is when they see this option trading for a profit. So if this, we sell to open for $2 and then now it's trading at $1.25, you're looking at a $75 profit. You're like, wow, that looks great. I want to take that. Well, unfortunately, in the net, you would have lost money because if you took this down for a $75 profit and you have a $100 realized loss, you still lost 25 bucks. So you can calculate your rolled options break even, which is something I definitely recommend tracking. I have an Excel sheet that does that, which I've thrown into the shop for all the Patreon members. If you're silver and above, you get free access to it. It's just a simple tool to help you track things. So now, if we continue on our best practices, what's the best time to roll? As you know, my answer to this already is it depends. There's two things you really need to answer right up front. The first thing is, what is your objective for the position? And the second thing is, what do you think about the underlying? So let's say you have a position on. The best time to roll in terms of getting the highest variability in your strike price is when you are at the money or slightly in the money. The reason being is even though there's a bunch of extrinsic value left in that option, you'll notice you're not moving a bunch of intrinsic value, which decreases how effectively you can roll. So what this looks like is, let's say you were short this 39 put. That's now, it's in the money right now. And it's trading for like 35, 36 cents, something like that. If we try to roll this and we want to go out 1 week and we want to collect a credit, meaning the rolled trade is bringing in more money than what we're closing. If we take a look at that and we know that we need 35 cents, can you get it going further out of the money, going out just 1 week? No. So we might have to go out. Let's just pick the next primary expiration. You can find you can roll out in time for a credit at the same strike, or you can roll out in time and slightly out of the money, taking it all the way down to a 28 delta while collecting a very small credit. So when the option price is the same as the strike is when you're going to have the most choices available to you. However, it's also when you're buying back the most extrinsic value. So if this is something that you don't mind taking assignment on or don't mind managing in the long run, then you can wait a little bit, wait for some more of this extrinsic value to bleed out, and then you can adjust. If this is something that's like leveraged options, or you really don't want to take assignment, in this case on the short put, and you don't want to get stuck. What I mean by getting stuck is if you wait until you're too far in the money, you get to a point where you actually can't adjust down. You can't roll down anymore, or if you're on the short calls, you can't roll up anymore because you're too deep in the money. And then you run into another problem, which is days to expiration liquidity. So for example, let's say our option fell on the money, the 39s, we want to roll out and down. Cool. So we go out and down. We have to go to 40 days to be able to roll down. Now we get our small credit. You're $1 better. But let's say time passes and XLF falls more. 4 days pass. XLF falls more. Now your 38s are in the money. Okay, you're like, crap, I got to roll out again. Well, I can't roll out just 1 week and get a credit. It's not enough. So maybe if I roll out 2 weeks, well, do you notice what just happened? Right here, you had 40 days to expiration. Then you were able to look out to 47. Now all of a sudden it's 53. Then after 53, it's 75. What's happening here is options chains offer more expirations the closer to time you are. Some options chains will offer you a bunch of choices. If you look at something like SPY, anything within 53 days, you have a ton of choices. But even then, after 53 days, it gets more and more sparse. That's days to expiration liquidity. And that's why it's a problem. Because if you roll immediately, every time your strike is challenged, let's say you're in this 33 days to expiration, you roll when your strike is challenged. Then you go to the 40, then you go to the 47, then you go to the 53, then you go to the 75. Now you're out pretty damn far in time. Theta is not ticking away that fast because you're so far out in time. And then if you get a continued down move, then where do you go? You got to 103 days. What if the down move continues then? You run out of runway. And if the underlying continues to move against you, you build a really difficult position to move around. So when I think about the best time to roll, I balance how do I feel about taking the underlying in or out, whether I'm short puts or short calls for long or short stock. And then I think about what is my disposition towards the underlying, because sometimes the best time to roll is never, and to take the loss. If you're trading something like this, let's say you had cash secured puts out on Carvana and you were all the way out here, you were trading it a while ago when it was 300 bucks. And then you're trying to roll your options, If you got stuck, you're stuck. There's no rolling your options from here to here. Sometimes if you get enough price accommodation in the short term, you might be able to get by with some of it, but big moves that happen quickly can leave you stranded. So you have to strongly analyze the underlying that you're trading. And again, the same thing can happen to the inverse. If you're one of those real smart contrarian traders and you know better when the market's pricing things and you see this big green candle, you're like, wow, I'm going to fade this. And SMCI hasn't come back. It's gone from $400 to $579. So in this case, you get stuck. You need some sort of price accommodation in order to be able to roll and eventually find your way out of the money. Because the problem is, can you roll forever? No. Because if you go back to this original example, you are realizing losses if we're rolling a losing trade. So when you're rolling a losing trade, each time you are eroding your account value. Sooner or later, the margin requirement for your trade is bigger than your account value. So even though you might have a bunch of cash sitting in your cash and sweep, if your net liquidating value isn't high enough to cover your margined requirements for your trade, you cannot put it on. So you cannot roll forever because you eventually do need price accommodation. So the last thing, how do we think about rolling in or out, up or down? I tend to try to roll out as little in time as possible. It allows me to maintain the most spot price sensitivity. It also gives me more runway on that days to expiration liquidity concept that I was explaining to you. So if I can roll from this 12 to the 19 while adjusting my strike, I typically would do that. If I can roll from the 12 to the 19 and not adjust my strike, meaning if I have cash secured puts, for example, and I can't roll them here, but I can roll them in the 26 DTE, I need to analyze the underlying. Do I want to add 2 weeks? And depending on how much I'm improving my basis, does that make sense? So overall, the decision on whether or not you go further out in time comes down to how do you feel about the underlying and running out of DTE liquidity, and then rolling down or up depends on how much money you want to make. Because if I try to roll, for example, from the 12 to the 19 DTE, if we look at this scenario, and let's say I'm at the 575, so I keep the same strike. In this case, you have what, 2675, and this is, just call it 35. In that scenario, you can still make an okay amount of money by staying at the same strike. If you chose to go from the 575s down to the 570s, notice what happens. Instead of getting $35, whatever this is, you're going to get 32 and change. So you have to decide what's more important to you. Is it improving your basis, adjusting your basis, or is it collecting more money up front? That is 100% dependent on the trader. So this is part one. As you can tell, it's a big video. There's a lot that goes into this. If you have any questions, let me know. If we should do a part 2 and go even deeper with specific examples, let me know, because we might be able to swing that. Till next time, like, subscribe, share, be an outlier. See you guys later.